Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. U.S. politics have shifted from being a cooperative game to a zero-sum game, very competitive, and the low-growth macro environment mirrors that. Joining me to discuss is Matt Forrester, CIO of Lockwood at BNY Mellon. Matt, it's great to see you again. Welcome back to Trade Talks, and give us more detail on the backdrop investors and voters are contending with.
Right. So as you said in your headline, so we think U.S. politics has come from this cooperative game to a hyper-competitive zero-sum game, and what that means, in a cooperative game, Reagan and Tip O'Neill can meet over lunch and come to some general agreement on where they want to take the country. Today, if Dianne Feinstein and Lindsey Graham want to have a hug after a tenacious hearing in the Senate, they are unable to do that, and she gets scolded by our party leader. So in a zero-sum game, Republicans can only advance at the expense of Democrats and vice versa. Just examples, we had no Republican votes for Obamacare. We got no Democratic votes for Amy Coney Barrett. There's plenty of examples of how the U.S. electorate and the politicians have gotten further and further apart. And there's good reasons for that. And part of it is that right now we have the federal government's involvement in the economy at 33% of the economy. That's the largest share that we've ever seen. So politicians are fighting over control of a very large piece of the economic pie. And that is, a really challenging environment, again, leads to this zero-sum environment. And that environment really mirrors what's going on in the general macroeconomy, where we have very low growth rates. Look, we just came off a quarter where we saw 33.1% growth in GDP. Now that's an annualized number, so we're not going to see that growth, and that's going to begin to come down, and it's going to come down to the longer term growth rate for the US economy, which right now is probably somewhere below 2. If you take growth in people and growth in productivity and added them together, we're probably going to come into a growth rate that's going to continue to come back to a long-term average. And that's above zero, but it's not quite a zero-sum game, but it's very hard to get advances. So the economy is working in the same way. If you want to get a new customer, you have to take it away from someone else. So the economy is very hyper-competitive, and it's showing up in our politics. But I think probably where the rubber meets the road is that it means that the policy errors, have a potential to get amplified, especially if it's done out of spite. So there's not a lot of margin for error in our politics in this zero-sum game environment.
Now, there are a number of potential election outcome scenarios to review, especially since a contested result and unsmooth transition is a reality. What's the potential impact to the markets with that?
Yeah, so I'm going to try to simplify it to what I think are really a binary risk environment. By binary risk, I mean it's like an equivalent to a digital world. There's a 0 or a 1. And I would put the 1 is something akin to the status quo, where there's something that is like gridlock. The parties have mixed control over the various levers of government, obviously the administration and 2 houses in Congress. And if one of those is mixed, it will probably block the other party from initiating a very large series of policy changes. Of course, if we get the blue wave scenario, which is seen possible, from the polls, that brings into, account some very significant changes in fiscal policy. There's large policy differences from these candidates on taxes, on regulation, on climate, on geopolitics, probably on many other things. But a binary risk environment is particularly difficult for asset allocators, because you're trying to figure out where you want to be positioned, on either side. And that's a difficult place to be, because you're not quite sure which one is going to end up being the reality. But I think we can kind of simplify that to 2 different modes, which is gridlock and a blue wave scenario. I guess it's possible that you could have all 3 houses held by Republicans, but it seems like the polls are indicate that's a very unlikely scenario, and probably haven't spent too much time on analyzing it at the moment.
And typically, it's not the person who gets in the White House, but the macro policies that influence the markets. What are your thoughts on monetary policy, inflation, interest rates?
Yeah. Well, some would say that election outcomes don't matter too much to the markets. No matter who wins this election, we're likely to get some combination of relatively expansionary fiscal policy married with very accommodative monetary policy. That's likely what we're going to get in either way. Sure, the policy differences are very much there, and I think they'll have to be worked through. But in case of monetary policy in the Fed has signaled that it intends to keep interest rates at the zero bound until the next election cycle. So we're going to be talking about the 2024 election, and it's possible the Fed will be, exactly where they are today, which is back at the zero bound with a lot of different accommodative policy effects in play. They've now stated that they are going to be willing to accept some additional inflation, perhaps above their target. They would see that as the inflation target of around 2% as a average measure. So they may be willing to let inflation run a little bit hotter than that in the short run, or maybe even the medium run. So monetary policy and short-term rates are on hold for a while. And I guess one of the possibilities of having all this stimulus is that the bond vigilantes are starting to wake up. That was a Clinton era term where the bond market would punish large-scale fiscal expansionary programs on behalf of the Clinton administration at the time, and they may be, coming back to life here. It's possible that markets are starting to begin to price in maybe some additional inflation from all the stimulus, and that's probably going to affect the pricing of longer-term bonds. It seems to have started to, but I just point out that what we've talked about this in terms of a possible repricing, it's been about 15 basis points. I mean, we've been stuck between 70 and 85 basis points or so, or in this trade range on the 10-year note. So we haven't talked about too much of a move yet, but we'll see if that actually happens. But depending on the result of the election, it's possible that we could see some additional repricing of bonds. So I guess all of this is occurring, in the backdrop of, really large deficits and federal debt to GDP. We've never run deficits this large as percent of GDP outside of wartime. Federal debt to GDP has never been this large in our nation's history. It surpasses even levels that we ran up to fight World War I and World War II, and now we're fighting microscopic particles. So we're approaching, the large debts that have been incurred in modern history, such as the UK coming out of the Napoleonic Wars, or Japan in very recent market history. So as we run these large deficits and amass these large sizable debts, it's possible that market participants are going to be a little disappointed by the amount of additional fiscal stimulus that we're going to be able to do. We just saw that we were unable to come to an agreement on another fiscal stimulus package, largely because the Senate Republicans were balking at the price tag. But it's possible that other members of Congress begin to come in and say, wait a minute, we are really spending a lot more. We're going to pass this bill on to our children and our great-grandchildren and our great-great-grandchildren, and they might have some reluctance to go ahead. We're just bumping up against some of these longer-term institutional constraints on debt.
Yep, and the thing is, the later we have to wait for this, and the more infighting it is, it's only going to get more expensive. And people, it's one thing for politicians to fight back and forth, but some people don't have another 2-3 months to wait for stimulus
Sure.
checks. And that's really the tragedy out of all this. So Matt, to wrap up here, what are some of the key economic indicators you're going to be watching for the remainder of 2020 and what 2021 may hold?
Sure. Well, the employment situation is key. Payrolls are still 7% below the pre-COVID levels. So there's been large-scale destruction of capital and labor in this event. Now, the labor side probably keeps the Fed in this stimulative environment for a while. Remember, that's one of their key mandates, is to create full employment conditions in the U.S. economy. So the macro data lately has been very encouraging. We're seeing a V-shaped recovery, but the labor side is still lagging, and we're going to need that to improve. If we get a blue wave, we're going to really have to assess how this sizable tax plan is implemented and whether or not it has adverse effects on the economy. Just to give one part of the plank, we have on the platform is the largest capital gains tax in history proposed, and that has typically been good for a 5% correction, and this is the largest one in history, so maybe it's more than that in risk markets in the US. So, those are the types of things I think we're going to need to address. And finally, it's the virus itself. What is the path of COVID? It certainly has been very discouraging lately. I think one of the very key reasons why, not just in the US, but globally, we've seen risk markets really struggle to advance and actually decline on the type of infection rates we're seeing across most of Europe and parts of the US. So if we were to get a vaccine that was approved and accepted and was effective, that would be a tremendous positive for markets, but we're going to need to assess how the virus is continuing to work through the global economy, as we look through into next year. And it looks like this is clearly going to be an event that is going to be with us for quite some period of time.
So Matt, let me throw one more question on you. What are investors supposed to do? Take everything out prior to the election tomorrow and see how things play out? I mean, there's a lot of opportunity lost there too.
So consider that before we went into the 2016 election, the VIX, or the volatility gauge, the implied volatility S&P 500 was about 14. Well, today we're at 37. So we're already in this very tenuous volatility environment. Well, that could mean that we have a lot of volatility to work off. We have a volatility premium to work off as uncertainty reduces in the next couple months. We get an election outcome. That's typically what happens, is that as we go into November and December, we get a market rally as the uncertainty premium fades away. And that's certainly possible this year, but we have no idea when this outcome is actually going to present itself. We just don't know when we're going to know. It could be days, it could be weeks, it could be months. Likely, the markets are going to give us very clear signals about when they think the election result is even if it's not officially certified. The markets are a discounting mechanism. They look ahead. They're going to tell us when the election results are likely over, or what they're likely to be, and that's probably going to occur ahead of time. So I think the next couple of weeks are likely to be fairly tumultuous, and then we'll finally start to see some kind of calm down. But of course, all these other factors are still in play, such as COVID particularly, and the status of this recovery, which may be stalled because of the inability to get through the partisan differences on the stimulus.
All right, Matt, great to catch up with you as always. Thanks for joining us on Trade Talks.
Hey, thanks, Jill. Good to see you.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.